Good afternoon. I'm very pleased to welcome all of you to this important forum on the implications of the United States debt default on the American economy and global financial markets. As ranking member of the Financial Services Committee, I appreciate the importance of raising the U.S. debt limit and the real implications a default will have on our businesses, our economy, and our way of life. I'd like to thank our panelists for joining us here today, as well as our moderator, Neela Richardson, Senior Economic Analyst for Bloomberg Government. I have no doubt this is going to be a robust discussion and still a very timely one based on everything that's going on. My goal today is to hear directly from our panelists on how the failure of Congress to raise the debt ceiling could affect the U.S. economy, financial stability, investors, and consumers, particularly as our economy continues to suffer from the continued government shutdown. I believe holding the full faith and credit of the United States hostage sets a bad precedent that can have global implications. As many of you know, the mere threat of default has already caused instability and uncertainty that is sending shockwaves and volatility through financial markets. Businesses have already started to cut back and are reconsidering spending and hiring. JCPenney, Walmart, and Sears have already canceled large holiday orders and falling demand. Consumer confidence has shrunk to its lowest level since 2008, and many potential homebuyers now unsure about what the future will hold have held up on purchasing a home. Defaulting on our obligations will exacerbate all these problems and could affect the underpinnings of the entire financial system. A default could possibly trigger a financial crisis, remnants of the days following the failure of Lehman Brothers. Only this time it could be far worse. If the U.S. defaults on its debt, lending, the lifeblood of our economy would dry up, the dollar's value could drop, and we could see dramatic increases in interest rates on everything from mortgages and auto loans to credit cards. If Congress cannot do its job in a timely manner in the future, the government's ability to pay its debts will be looked upon with uncertainty by investors and the markets, leading to higher borrowing costs in the future and an increase in our nation's deficit. Every U.S. corporation and municipality would likely see their borrowing costs climb as well, and a default on our debt could reverse the slow but positive progress on reducing unemployment. But worst of all, we could see another dramatic loss of wealth for working Americans. History tells us that even the threat of default can send shockwaves through our financial system. In 2011, just the prospect of defaulting on our debt caused a drop in consumer and business confidence, a 17% decline in the S&P 500 index of equity prices, and increased volatility in the stock market. In total, American families saw a $2.4 trillion decline in household wealth and an $800 billion drop in retirement assets. And of course, we received a downgrade in U.S. government debt. And while 2011's hostage crisis showed us the very serious consequences debt limit brinksmanship, no one knows with certainty the full extent of the damage to the economy should the U.S. actually default on its debts. We've heard speculation ranging from the bad to the catastrophic, and we're hearing the concerns from actors in all parts of the economy, from Wall Street CEOs and U.S. Chamber of Commerce to small business owners and prominent conservative economists. They're all concerned with the significant damage that could result from a debt ceiling standoff. Warren Buffett, Ben Bernanke, Hank Paulson, and the heads of the nation's largest financial institutions have been outspoken about the need to stop playing politics with the ability of the United States to pay its bills. Just this weekend, Christine Lagarde, head of the International Monetary Fund, said that U.S. default could, quote, mean massive disruption the world over, and we could be at risk of tipping yet again into a recession. Obviously, this is a critical issue with enormous implications. I welcome today's discussions so we can better understand from those on the front lines of these crises, banks, financial institutions, and others in the financial services industry, exactly how this will impact their businesses and the broader economy. With that, I'd like to introduce those persons who are here with us today, who are giving of their time to be with us, to help us to understand the implications of this business that we're involved in, particularly with the raising of the debt ceiling and, of course, the shutdown. I'm very pleased to introduce our moderator for today's panel, Neela Richardson. Ms. Richardson is a senior finance analyst at Bloomberg Government, where she conducts research on financial regulation, housing, and derivatives. Previously, she was a research economist at the Commodity Futures Trading Commission, a senior economist at Freddie Mac, and a graduate intern at the Federal Reserve Board of Governors. She was also a researcher at Harvard's Joint Center for Housing Studies. Ms. Richardson has taught economics and finance courses at both the University of Maryland and the Johns Hopkins Carey School of Business. She received a PhD from the University of Maryland and has degrees from the University of Pennsylvania and Indiana University. Please welcome Ms. Neela Richardson. I think, do you have all of your introductory? Thank you very much.
Well, thank you. Thank you, Representative Waters, for that very nice introduction, but also thank you for having such an important and timely panel. We are 2 days from a debt ceiling breach, so never, I think, in the history that I've been aware of has there been a more timely panel on the impacts of a breaching of the debt ceiling on the American economy. And you have invited a very well-represented panel to discuss these issues. So I'm really excited to be here, and I'm excited to hear what our panel has to say. Our first panelist, not by any particular order. So Marie Kavanaugh is in the middle. She is a managing director in the Sovereign Ratings Group at Standards & Poor Ratings Agency. Secondly, we have James Chesson. James Chesson is the Executive Vice President and Chief Economist of the American Bankers Association. Robert Toomey is Managing Director and Associate General Counsel at the Securities Industry and Financial Markets Association. Mike Williams served as Managing Director in Public Policy Division at Credit Suisse before launching the Williams Group earlier this year. Scott Talbot is the Senior Vice President for Public Policy at the Financial Services Roundtable, where he directs the overall policy strategy. And finally, we have Damon Silvers. Damon is the Director of Policy and Special Counsel for the AFL-CIO. He joined this group as Associate General Counsel in 1997, and I believe you have their extensive biographies. They're well worth reading. So with those introductions done, I'd like to go straight to the question of the day. What is the debt ceiling? Why do we have it, and why is it important? And I'm going to start with Damon to give us kind of a history of what this debt ceiling thingy that could cause this kind of catastrophe is.
I find this to be the boring part of the of this event because the debt ceiling is a very old thing in a way. It used to be the case back when we had financial panics that the federal government largely let run. That the federal government only borrowed by direct authorization of Congress. So it wasn't just a certain dollar figure. It was that Congress authorized each particular bond sale. I'm sure that's something that no one at this table would like to return to, but that's how it used to be. And starting in the in the 1920s, and then for real in the 1930s as the federal government responded to the Great Depression, Treasury Secretary Andrew Mellon, a very conservative Treasury Secretary, asked that issue by issue rule be lifted, and the Treasury be able to borrow money without having to go to Congress for each bond issue. But the idea of a dollar limit was kept, and has been in place ever since. Its statutory form has changed over the years. The punchline, though, about this is that since 1960, that number has been lifted, I believe, more than 60 times. And it is really only in the last 2 years that it has become an instrument of broader public policy. And in terms of understanding the history of this matter, that's really if in a sense, if in the 1920s and 1930s we took a step forward into modernity by recognizing that a functioning national government had to have some flexibility and shouldn't be going to the Congress every time a particular bond issue was sold. In the last couple of years, we seem to have taken a step backward, that now we're going to fight over this number when we've never fought over it before.
Thank you. And that's an excellent segue to the next question, which will go to Scott at the end of the table. How did the debt ceiling get so, and the authorization to raise it, get so tied up into the budget battles and the policy priorities in Congress?
Yeah, I think it became a must-do. As everyone knows in Congress, if there's a train that has to move, then that becomes the target for pro and con forces, and an opportunity for everyone to get a piece of legislation moving that wouldn't otherwise be moving. So as a must-do piece of legislation, it's something Congress has to act. It has become the focal point for both sides in terms of negotiating over things related and unrelated to try and get the country moving one way or the other. So it's become a good thing as well as an albatross, depending on how you look at it.
Do you still think it's a necessary thing? And anyone on the panel can jump in.
Yeah, I think largely what Damon said is partly correct in that what a challenge that would be every time the government wanted to do a bond issuance, the Congress had to approve it. At the same time, it's not necessarily a bad thing if you try to use it as a way to force budget negotiations or discussion about the budget. If that were the case, then it wouldn't necessarily be, it would actually be a good thing to require Congress to come together on a budget.
And Mike, I see you nodding your head.
I just wanted to state that, when Damon talked about this being unprecedented, it's not, right? This has been used by both parties in the past as a sort of lever point, but as Scott noted, it's always been used centrally around budget questions, right? In 1995, I was telling some of the folks here earlier, I started White House, and 3 weeks after that, I got furloughed because that was the government shutdown in 95, and that was driven in large part by the desire to shrink the size of government. And because there were no discussions on the overall spending levels, that led right into the debt ceiling debate. Now, having said that, I believe that it's necessary to maintain that lever of control because of the way, again, the rest of the world looks at us. And it, in my view, should not be the case where there is just unfettered ability on the part of the administration, any administration, because, depending on how you get along with one, you may think that, that's a good guy, and then, it changes. I think that there should be a congressional role as the Constitution mandates, but we should never go back to having Congress, and I'm sure these members would agree, not have to approve every single issuance. There needs to be some control, but again, I think the focus needs to shift not away from budget-related issues.
Right. And hello. I'd also like to take the time as we start these initial questions. We will do a question and answer period for about an hour, and there will be time reserved for members of Congress and others in the audience to ask questions. Along with that, the big market impact of breaching the debt ceiling is something that's been all over the media, and yet we haven't seen an emotional reaction to the fact that this debt ceiling could be breached in 2 days. I'd like to ask Robert from SIFMA, why hasn't the market reaction been more palatable?
First on that, there has been a market reaction. Let's sort of maybe in the equity markets, and that's what people look at, it's been less profound. But certainly in the fixed income market, in the treasury market, and in the repo market, there has been over the past month or so, I'd characterize them significant changes, particularly at the short end, particularly around the securities that are subject or may be subject to either interest payments or principal payments over the next month or so. And I'll just highlight a couple of the impacts. In the repo market, we've seen short-dated repos rates rise significantly from almost near zero, based on Treasury securities, repos on Treasury securities, from near zero up to 15 basis points. That strikes me as significant.
And can you break down a little bit further why is that significant, what impact that has on borrowing costs for the market?
I'll get to that. And then also within Treasury rates generally, we've seen a number of firms announce that they are actually getting out of their positions in these subject securities over the next month or so. And that has an impact on their price, and that has an impact on the rate. To your question about how the repo rate and the other rate bleeds through, I guess, to the real economy. Remember, Treasury rates generally are the benchmark for housing, for mortgage rates, for car rates, for consumer debt, for corporate debt. That's important to follow, and that certainly bleeds through the economy. The repo, just a few fundamentals about the repo market. The repo market is incredibly large, roughly $4 trillion a day, depending on how you look at it. Chunk of that is Treasury repo. That's kind of a baseline that firms, financial firms, credit intermediaries, that's how they fund themselves. And in many ways, that's their cost of borrowing, and that gets passed through certainly to the consumer sector. Now, we speak of, the debt ceiling or default is unprecedented, it is, but we do have some precedent. At 2011, we came right up to the deadline, and we saw costs in the market, very similar to what we've seen the last month or so. Movement in the short end of the repo market. I would think if we cross that, you'd see across a larger part of the curve more significant advances or changes in price.
And along with that, the repo and the fixed income markets, there would definitely be an impact on interest rates for consumer products. Jem, could you touch on that for us, please?
Well, absolutely. I mean, as Rob was saying, the treasuries are the risk-free asset. They set the benchmark not only in the United States for all the rates, but worldwide. And when other countries were feeling the pain, such as Europe, money was flowing into the United States, and we've been the beneficiary of that. Every bank, of course, deals with borrowers, and it's just like, I'm sure all of you have a mortgage, credit card, auto loan, or something, and if you actually default on those loans, bad things typically happen. Your rates go up. It's harder to get credit. And if it's the United States government is the one that is defaulting on its obligations, and even if it isn't the mortgage, if it's the lights or any other payment that they have, it has severe consequences, and that will flow through. The one thing that really concerns us, and we've already seen it already, is because of the shutdown, is small businesses are suffering income losses now, particularly those that deal in areas that have heavy concentration of government workers. They will never get that money back. That is lost income that is going to affect them not only now, but throughout the rest of the year, particularly coming into the retail side of things around the holidays. It's that uncertainty that freezes business decisions. If businesses are uncertain about what their costs are going to be, or what the government may do now or 3 months from now or a year from now, they will not make decisions to expand. They will not make decisions to hire. They will clam up and wait till things settle out. And we've already seen some of that uncertainty develop, and as other members have said here on the panel, it will only be magnified if there's actually a default. That will send ripples through the economy that will not only affect the credibility, of course, of the United States, but affect every business decision that is made here in the U.S.
Right. I'll get to you in a second, Mike. I'd also like Scott to chime in here, because you also represent a group that deals on the front lines with consumers and their mortgages. Is this is this debate over the debt ceiling, has that had an impact on business? And then could you speak to what an actual default would
Sure.
look like for your?
Sure.
for
It absolutely
consumers?
has had an impact on not just small businesses, but larger businesses. We see for small businesses, the demand for loans has dropped, or at least applications have dropped as banks or businesses, as Jim points out, have pulled back. The uncertainty has caused them to sort of slow down. That's going to lead to failure of businesses. It's going to lead to terminations. So there is going to be an impact on the small businesses. In terms of the average consumer, we haven't seen, obviously, a change in the interest rates yet. But we have seen, at least last week, we saw a drop in the stock market. It came back. But a drop in the stock market hits everybody's 401k plan, hits your IRA plan. So you have less tangible assets and you feel poorer or less wealthy. Even if it's only temporary, that's real money to a lot of people. So in the short term, we have seen, in anticipation or fear out of default, we've seen hits to loan applications as well as some 401k plans. If we actually go over the cliff, or I shouldn't use cliff, but if we default and we see a rise in interest rates, then payments, the variable rates will increase on mortgages, credit cards, student loans, and customers will have less cash as they have to divert, less disposable income as they have to divert more money towards those payments. So they will, from a cash flow basis, will be hit, and obviously we'll see a drop, at least in the equities market, if we default. So their 401k and IRA balances will drop. So they'll be hit with a double whammy: less cash, less assets. And as Ben Bernanke said back in 2011, that would be a recovery killer. So whatever recovery we're experiencing now, it may be modest. We may be bouncing along the bottom, but at least we're moving in the right direction. A real default, would halt that, and actually reverse it.
And there's a lot of questions in my mind what a real default means, and we're going to get to that, Maria, in a second. But Mike, you wanted to jump in.
Yeah, I just wanted to point out two things. And I used to work with Rob at the Bond Market Association, and we've had this discussion a lot with a lot of policymakers. If you really want to see what the impact of these policies are on the market itself, it's not to look at the rise and fall of the Dow Jones or the S&P. It's to look at the credit default swap market. And that tells you exactly what people believe is happening. That was a great indicator that the administration, both Bush and the Obama administration, used after the financial crisis in 2008 to figure out exactly where these companies were. And if you looked at it on a day-to-day basis, it would have told you exactly where Lehman stood, where all of the banks stood, quite frankly. And right now, if you look at the cost to ensure a risk-free the risk-free currency, essentially, of the world, it's about 80 basis points, which is, almost 1%. And that is ridiculous. I mean, you think about something that should be absolutely risk-free, and you think it costs that much to do that, that gives you an indicator that the market is, in fact, reacting. It's just a matter of what can be easily digested and put into a soundbite for TV. And I would add, from a mortgage perspective, the market is being artificially propped up now because of what the Fed is doing and all of the buying that's going on. Going over, or having a default, you would see an increase because you couldn't help it, because the shock to the economy would be such. But I think that it's important, particularly for the members, to keep in mind there are other issues out there. There are other issues that are being dealt with regards to GSE reform and their proposals to have a completely private market. And if that, in fact, were the case, and then you did not have this huge infusion of federal cash, then if we were in that situation and we were in the current sort of fiscal cliff, part 2, then I think you would have a very debilitating impact on mortgage markets, and not just in those areas hit after the financial crisis, but across the entirety of the country.
Right. So what I'm getting from the panelists is you shouldn't look at the Dow Jones to see market impact on the debt ceiling right now. That there are all these markets that affect borrowing costs that really are showing some stress. And so, given that stress may pop in 2 days, this is a great time for Marie to really tell us, what is default? What does it look like? And are there different stages of default?
Okay, thank you. Well, first of all, Standard & Poor's thinks that the current impasse over the debt ceiling and the continuing resolution is unlikely to change our rating, which is AA plus with a stable outlook. We moved the outlook to stable earlier this year for 3 reasons, basically. One, we were encouraged by the government compromises that lessened the impact of the so-called fiscal cliff earlier in the year. Second, there's been a tremendous amount of deficit reductions over the past 2 years. The deficit for this year is about half of what it was in 2011, and under current policy is trending down. That's not to say there aren't fiscal issues, because it begins to trend up in a few years. And the last reason is that the economy is stronger, and usually in that kind of environment, it's easier to find compromises, and also the issues aren't quite as difficult as they were in 2011, when it was the 3rd year in a row that the United States had a deficit of double digits as a percentage of GDP. It was 10% in 2011. So we do think that the debt limit will be raised, perhaps at the 11th hour, as has happened many times in the past, and we think that that risk, weighed against many of the strengths of the United States, underpins the AA plus rating that we have now. But the brinkmanship is really the primary reason the Standard & Poor's rating is no longer AAA.
Right. So what happens on October 17th? I share your optimism. I share her optimism. But we're here to talk about what a default would mean to the economy. On October 17th, if that debt ceiling is not raised, what happens to the U.S. credit rating?
Well, if the debt ceiling is not raised by the time the government needs net new financing, there has to be a cut in expenditures, a very dramatic cut in expenditures. There's been a cut in expenditures with a shutdown, and we estimate that is reducing 4th quarter growth by about 30 basis points, so about 3%, 0.3%, not 3%, 0.3% off of what we expected 4th quarter growth to be for each week that shutdown continues. So we do think that it's having an impact on confidence, on investment, and on hiring, and there is a negative impact that's ongoing. If there had to be a big cut in spending because there was no net new financing, that would be a much bigger cut with a much bigger impact on the economy. What we would expect to happen at that time would be that the Treasury would announce its plans for dealing with the fact that spending would have to be cut fairly dramatically. It's hard to look at other defaults and draw parallels with what's going on in the United States. Standard & Poor's has had 14 rated sovereigns default. But each one of them has defaulted after a number of years of growing political and economic stresses that compromised access to financing, both domestic and externally. That's not what's happening here. The economy, in fact, is actually doing better than it has been in recent years. What's happening here is brinkmanship in branches of government. So it's hard to make those comparisons because, and also for the other defaults, in the wake of the default, the discussion was about what would the recovery be on the defaulted debt. So in Argentina, in Greece, which was Greece and Cyprus, Cyprus defaulted this year, Greece twice last year. The recovery was in the 20s, 20% or so, on the defaulted debt. I think everybody expects that the recovery in the United States would be full 100% because it would be. Interest and principal would be paid as soon as the debt ceiling was raised. So the parameters are quite different. On the other hand, unlike those other defaults, the United States has the world's premier reserve currency.
Right.
And as other people have mentioned,
we're not Cyprus.
We're not Cyprus. Well, Cyprus was actually fairly important internationally, but not like the United States. No, that's fair. And so as people have mentioned, U.S. Treasuries are an important part of the collateral in the repo market. And it's very difficult to estimate what the impact would be because this is an unprecedented event.
Right. And Damon, you wanted to jump in here as well.
I think one thing that has been missed here in this conversation really comes up in what Marie was saying about what happens if the debt ceiling is not raised. And it goes back to why the debt ceiling itself is legally problematic, right? Which is that we have a statute that mandates that the president spend the money Congress appropriates.
And Jim, could you turn on your mic, please? Thank you.
we have a statute that mandates that that the president spend the money that Congress appropriates. We have a constitutional amendment that says that the debt of the United States shall not be called into question, and we have both the Constitution and statute that makes clear that the president cannot raise taxes without Congress's authorization. If you put those three things together, they're a mathematical lock without the debt ceiling. Right? They require a certain. If you put those three things together, if you don't raise taxes to cover your congressionally mandated spending, you have to borrow in order to pay the debts. They are a legal lock. If you then and they are all matters of of exercise of congressional power and oversight. So that if you add the debt ceiling onto that and you don't raise it as a matter of course, you've essentially put the Congress has put the president in a legally untenable position. There is no way to comply with all three of those legal requirements, which have equal or superior standing to the debt ceiling itself. Now, that means that it's not so simple to simply cut expenditures, right, if the debt ceiling is not raised. And this is why the Treasury Secretary, Jack Lew, has made clear that if the debt ceiling is not raised and if the United States runs out of cash, that no one should feel safe that their obligations are going to be paid. No one. Not long bond holders, not short bond holders, not Social Security recipients, no one, because it is simply unclear how to comply with the law. And thus you have the problem that if the debt ceiling is not raised and if something else isn't done, then you have there is a serious risk. And I think each member of our panel has spoken to this. There is a serious risk that the United States will willfully choose to forfeit its status as the printer, the provider of the risk-free asset in the world. Because while it is true that we are not a bankrupt country, if we choose to not pay our debts, even though we have the money, the world will treat us like one, and the consequences of that are unknowable. Right? They are unknowable. And what I mean by that is, and I'll ask you to remember a few years back, Hank Paulson and Ben Bernanke bailed out Bear Stearns because they didn't know what would happen if Bear Stearns would fail. That's what they said at the time. They then did not bail out Lehman, and the reasons are a little murky, but I'm personally convinced that they thought they knew what was going to happen. We don't know what will happen if we forfeit our status as the provider of the world's risk-free asset. We just don't know. We don't know how resilient our money market mutual funds are. We don't know how resilient the institutions that are involved in the $600 trillion derivative market that prices to these assets are. We don't know what will happen in the repo market. We don't know. And if you think for a moment about what happened the last time we thought we knew and we didn't know, this is a far, far greater risk to take.
Yet, Damon, and I'd like Rob to jump in here. There are those who say that as long as the United States makes its interest payments on its bonds, that we have not technically defaulted on our debt, which opens up a door that we will talk about on debt prioritization. But I'd like Rob to jump in here. Is that the case? Is that the standard by which default will be measured in the markets?
I'm not sure about that, because think about how you analyze or how you would look at a corporate borrower or a household. If they're paying and timely paying some debts but not paying others, do you extend them credit on the same terms that you would a creditor who is making all his payments timely? That's one consequence. So you would wind up paying for that. The markets would price that risk in. But the other risk is the fact that there would be incredible, it seems to me, uncertainty around your payments for Treasury securities. You don't know. We don't know. And Secretary Lewis certainly said they don't know what their cash needs are on any given day. They don't know what their receipts are going to be on any given day. So once you stop paying in one sector, where you stop that, how you have certainty that you're not going to not pay in other sectors is an open question. That uncertainty, again, has to be priced in the market, has to be priced in the cost that investors are going to try to get from Treasury. And interest rates will then bleed up, and as we've all said, will impact the broader economy through interest rates, consumer loans.
Right.
et cetera.
So-
And additionally, if I could, you
Sure.
also don't sometimes have the option to just pay the interest because certain principals come due.
Right.
And so you have to either roll them over, which would require refinancing, or pay off the bondholders.
And that's very true. It leads me to another question. There's been some analysis that shows that the major payments aren't due until several days after October 17th, those on Social Security and Medicare. How do the markets, Jim, maybe you can jump in, or Rob, or Scott, everybody can jump in here. How do the markets react in that interim period if we breach the debt ceiling from October 17th when we're not actually, haven't actually defaulted on debt to November 1st? What happens in the market?
Well, let me jump in. I guess I'm always surprised when we have discussions about the exact time something happens or how we define default.
Right.
If you default on your mortgage, or let's say you're paying your mortgage in full, but you don't pay the light bill, you don't pay any of your other bills, they turn the lights off. Bad things start to happen. You know, so to narrow it down, I think is missing the whole point. There will be bad things that will happen even if we can somehow, and I think there's an issue of technically, can you meet the obligations, the Treasury obligations? Certainly bad things happen there, but it's, as Marie was saying, other spending disappears. There are other obligations that are not met, and that creates a cascading effect for everything. So it seems to me we're focusing on the wrong things here to worry about the exact time. If we go past and there is one missed payment, whether it's on Treasury securities or other obligations, it will flow through and everybody will be worried they won't get paid, whatever that obligation is.
If we do default, Mike, the Treasury has a couple of options, none of which are very good. But the two that seem to be most prominently discussed are prioritization of debt payments, generally in terms of interest payments, or delay until the revenues accumulate enough to make that payment. Which is better for the economy?
Neither. I mean, there are two problems with both of those. In the short term, the Treasury system is not set up to accommodate either one of them. So it's not as if Treasury can reprogram its computers or somebody actually has a checkbook and they start writing checks. It's an automated system. So in the short term, if you're going to do something like that, that has to be part of a larger structural reform to make that an option. But both of them would be bad. And I could tell you, going back a few years ago when we had this debate, and at the time I worked for a small country bank, and one of the issues that small country was dealing with was the fact that everybody wanted to buy its currency. And I don't think that anyone should be, sort of led to believe that somehow the U.S. is not going to be the gold standard here, right? Regardless of how this thing turns out. And I think we all agree that it'll get resolved and, all of this is unnecessary. That's not the issue. And there's been some talk about that. The issue, though, is what impact does it have, again, from an investor standpoint, representing a group of investors in mortgage-backed securities, asset-backed securities. One of the things that investors want are certainty, right? You want to know that there's an ability to pay, regardless of if it's a mortgage or a car loan. What investors are looking at the United States is to say, it's not that the U.S. doesn't have the money or that they don't have the stand-in to be able to raise the money. They're actually choosing not to do it. And by choosing not to do it, that actually adds to the level of uncertainty, because I could live in my house and I could choose not to pay. And even if I tell my bank, well, I have a lot of money in the bank, don't worry, I'm good for it, that makes it worse for me. It doesn't make it better, because then they don't want to extend me any more time, and they don't want to work with me anymore, because I am choosing. So this, in my opinion, right, would be a strategic default. This is not an absolute default, as it was in the case of many of the sovereigns who fail, where they actually lost the ability, either through political or economically, to do that. This is a case where we would choose to do it for political reasons. And as Damon said, I just don't think that it's quantifiable. With Bear Stearns and with Lehman, no one knew, and no one knew what TARP was going to be like, right? And that all of those things worked themselves out. But that wasn't a situation where somebody actually chose.
not.
I mean, if you had a bank that just said one day, "Hey, look, I'm going to stop paying my creditors," I think that would be an easy choice for an administration.
Marie, does Standard & Poor's look at it differently, or do you look
Well,
at a
I think
default as a default?
In some ways, this comes back to the debt, the existence of the debt ceiling itself. Standard & Poor's has sovereign ratings 127 sovereigns, and there are very few that have budgetary processes that separate spending and funding. And I appreciate that some people argue, and it's certainly true that many times, I think 70-something since 1962, the debt ceiling has been raised, sometimes on a rather pro forma basis, sometimes with some negotiations about budgetary issues, and it's been a tool. In Standard & Poor's opinion, that whole debate has become much more acrimonious and much more difficult since 2011. But the separation of those creates just a difficult position that unless you argue and certainly believe that it's led to better budget outcomes that it would have had without it, I think we've seen in 2011 and see presently that then it can create great difficulties. And a lot of times people extrapolate from the individual or the family to the society, and it doesn't really work that well. Like if everybody saves, that's not necessarily good for the economy. It's good that some people save and so forth. It depends on where you are in your life and so forth. But this is probably one of the decisions that, one of the factors that does translate. When you get your credit card bill, you don't decide which parts of it you're going to pay, because whether you liked X, Y, or Z, you pay it because you already made that decision. And the separation of these decisions is very difficult.
Scott, do you think that the separation impacts our long-term budget outlook? I mean, we're going to have, in the most optimistic view of what's on the table now, we're going to have the same position in 4 months. We're looking at a short-term increase of the debt ceiling and a short-term agreement on reopening the government. How are all these short-term deals on the debt ceiling and on the government spending affecting our long-term projections of the deficit?
Yeah, I think that there's sort of two aspects to it. One is the procedural aspect of the debt ceiling and the only moving vehicle or a moving vehicle, and that will continue as an opportunity. Members of Congress will see it as an opportunity to negotiate the old Christmas tree problem. I think, though, that the issue of the U.S. government's overall financial health, fiscal well-being, as Marie pointed out, yes, the deficits are trending down, but we all saw the CBO report that says they're about to explode in a couple years. That is a more fundamental problem or challenge that faces the U.S. Congress on how to put the U.S. on stronger financial footing. The debt ceiling will be part of that debate, but there is a deeper philosophical and much harder economic choices that have to be made, and the debt ceiling is going to be the caboose on that train.
Right, and Jen, please.
Yeah, my big fear is that we only create even more uncertainty. So I totally agree that we have bills to pay. That's a credit card. We've already agreed with that. We need to pay those bills. And then we need to address the long-term debt situation, because you have to do both, right? You have to pay what you've already spent, and you need to manage the debt going forward. But I would hate to be back in a position, however long it is, where we're back 2 days before whatever deadline it is, talking about the same things because we haven't resolved this. The uncertainty compounds itself and means, again, that small businesses will just wait until something happens, and that will freeze their decision for however long it takes, and that will be devastating, particularly through the period that we're about to come in, the holiday season now.
Yeah, I want to go with Rob and Damon for the follow-up, because I mean the plans on the table are as follows: that we would extend Treasury's borrowing authority until February 7th and open the government until January 15th. How will the market react to these plans?
Well, I just wanted to address the short term. Our position is you have to raise the debt ceiling. You can't use it, the full faith and credit as a leverage piece. You do have to address the long-term fiscal issues that we have. But as you do, there are costs associated with each of these incidents. There certainly were costs, and they've been well documented around 2011 that people saw. We're seeing costs now, costs to Treasury in its borrowing that it's doing short term, as we noted before. So those costs get incorporated. Some of them get incorporated into Treasury prices over time, and then they're it's tougher to measure those, but they exist. And there's the actual immediate costs right before you get to any sort of debt ceiling rise. If it rises to the level that we had in 2011 and in this incident, you don't want that continually. That's a drag on your economy. The big point we've made is the uncertainty in the market. We don't know what will happen, but having that uncertainty continually has got to be a drag. It's got to be a drag on Treasury prices, and Treasury ultimately and the government winds up paying a premium for that.
Right. And Damon, you wanted to?
Yeah, I mean, I think what this conversation brings out is something we touched on earlier, but I think it's important to emphasize it. It's true that in the past, in 1995, the ability of, I suppose you call it the ability of Congress to shut down the government by not appropriating funds was used as a leverage point in a fiscal policy negotiation. That is true. That was unheard of at that time, meaning that that had never happened in modern times, since the early 20th century. What was new about 2011 was the use of the threat of default as a leverage point in fiscal negotiations, and now we have seen the use of the threat of default as a leverage point in broader policy issues. Right. That move, it may be the case, certainly as we sit here today, it certainly seems the case, that we are not going to remove the redundant, we are not going to remove the debt ceiling as a redundant fiscal instrument, which is what Marie was talking about, that other countries don't have this, because they assume when you make spending decisions and taxing decisions that you then do the borrowing you got to do to fund what you decided to do. Right. But if we leave that in place, and we leave it in place as culturally acceptable in our political culture to use it as leverage, we are going, and I think Rob said this in a kind of polite way, but I don't mind saying it more bluntly, we are going to, in dribs and drabs, destroy our own standing as the risk-free instrument in the world economy. And that is a matter of extremely serious strategic import to the United States to do that. And we can do it in little pieces. We can do it in one big piece. If we don't raise the debt ceiling and if we default on any of our obligations. And by the way, what are our obligations? They are not simply the bonds and the notes. They are Social Security, Medicare, payments to contractors, payments to payroll, right? Who was someone on the payroll? I think probably spoke up. They certainly they certainly are payroll, and anyone who has had any experience in credit markets knows that you start defaulting on your obligations piecemeal, everybody runs, right? If we have this relatively short hiatus before we do this again, everyone should understand that if we actually do it again, if we don't treat this hiatus as, oh yeah, we're not doing this anymore, right? This is not, it's funny, Mike and I disagree on a lot of things, but I think we're both genuinely horrified by the prospect of this as a prospect because of the profound way in which our country and the world economy is linked to the dollar as risk-free. If we do it drip by drib and drab, meaning if we do this again in 8 weeks and then again in another 8 weeks, we will forfeit our standing. We will forfeit our standing in increments, and it'll be every much as forfeit. And if you read what the Chinese are saying right now about the United States, you can see us forfeiting it, right? You can see us forfeiting it in real time. And I'll just say one more thing technically here. Understand that people talk about the dollar as the world's reserve currency. There may be some people who hold their dollars like, in mattresses and stuffed away in the insides of walls and stuff like that. There are people who hold their dollars that way. But most legitimate actors in the world economy hold their dollars in some interest-bearing instrument. And after 2008, people generally believe that the short-term treasury note is the risk-free instrument. So that when if you put that note in doubt as a debt instrument, which is what we're about to do if we keep on this path, if you put that note in doubt, it's not just the United States government and Washington and all that, it's the dollar you're putting in doubt.
Right.
Because that's how people hold dollars.
Yes.
I'd like to add quickly.
Sure.
If I may, when you talk about that, and Rob talked about the repo market, as I understand it, they're not accepting treasuries now in some instances as collateral for these short-term loans.
Yeah, and specifically on the repo market, we've certainly heard certain counterparties will not take, as I mentioned earlier, the treasury securities that are impacted over, say, the next month. They won't take them in repo. Makes them harder to finance. If they're harder to finance in the repo market, they're harder to hold. They're less attractive to hold.
Like
I mean,
you
from a larger sort of macroeconomic perspective, sort of stepping back from the debt ceiling, I think one of the big fallout, the big fallout from the 2011 escapade was that, you know, from an investor standpoint, the one thing that everybody needs to remember, and I say this a lot and everybody laughs, but capital is a coward. It doesn't like to be around problems. And it doesn't like to be around problems. The treasury market doesn't like to be around problems. The muni market, MBS, ABS, whatever it is. And I think that we need to sort of, when we talk about the market, capital M, we need to step back and start looking at specific sectors and not just at the sort of financial industry, but, you know, folks who issue corporate debt and whether or not they're going to be able to do that successfully. The folks who issue at the muni level. What happens when you actually, I mean, there's a process for issuing muni bonds. You can't hold that. You can't gain interest on muni bonds. So when these entities do that, they send it off to the Treasury. Treasury can't hold it because they can't pay them.
Right.
So therefore, that affects issuance at that level. And so from an investor standpoint, if you're going to put money into any kind of instrument, you want certainty. And I think that beyond the debt ceiling, not having addressed the sort of larger fiscal issues has actually cramped down on the market because you can't grow the economy if investors are not putting their money into a particular instrument. And everyone here knows that we've seen that in housing, where if not for the government over the past few years, it would be a little bit dicey. And now there are efforts on the way to expand that, but this does not help. Again, from an investor standpoint, that somehow the government is supposed to step in any kind of way if in fact you actually can't pay the basics.
Right, and I think that's an excellent point about the muni market. Scott, can we talk about this as a federal problem, but this is going to bleed into the states. Can you kind of touch on that for us?
Yeah,
what the
sure.
impact would be?
Obviously, going from the dollar being the reserve currency of the world, and Damon's exactly right, China is, just real quick, China is saying that we should start moving away from that. I agree with Mike, that's probably not going to happen. I mean, historically, we've changed the reserve currency, I think, 5 or 6 times. It used to be the British pound, blah, blah, blah. But they are sort of seeing this as an opportunity to say, hey, let's make it the yuan. You know, let's go. But in terms of the state level, obviously states issue bonds as well. They are not sovereigns as in nations, but they are their own sovereign entity in and of themselves. And they obviously hold treasuries and make investments in treasuries. And so all of this confusion, this uncertainty will translate down the state level and could result in an increase in their borrowing costs, which reduces their ability to serve the citizens of each state, as well as I don't think you're going to see anybody default at the state level because of this per se, but if they have to pay more for treasuries, that reduces their ability to have revenues available to serve their citizens.
So states, for example, that putting on my economist hat, can't help it, that were impacted by the housing bust, who are already in trouble borrowing, they may feel this debt ceiling a little bit more.
They will feel the pinch even more. Yeah, exactly.
I mean, quite frankly, they may not be able to issue, right? They may not be able to bring their bonds to issue if Treasury is in a sort of limited capacity, because once you issue a muni security and it has to ripen, right? And then you can't put that into an interest-bearing account. So you have to deposit it at a window at Treasury, and they hold it until it's time for you to be, you know, when you're going to use the monies. If that capacity is not available to you, you can't issue that security.
Okay. I wanted to ask you one question. It's a bit of a hornet's nest, so it's going to be the last question I ask. We all agree that the ramifications of breaching the debt ceiling would be terrible, bad, worse than bad, catastrophic. Should the president, under what some say he has authority to do under the 14th Amendment, issue debt without congressional authorization? And if that debt were to be issued, how do you think the market would price it? And we'll start with Jim because he looked up.
We're here before Congress. it's your obligation to make these decisions, and I think, and certainly work with the administration. I mean, it takes two to tango, I guess in this case 3 to tango, right? Or maybe more, yeah. So these are important decisions, and I think it really takes a collective effort to do this. I think the most important thing is to find a collective agreement that prevents us from going into default and then turning immediately to the big challenges, which is how we manage our spending and the debt we accumulate later.
Okay. And Damon, you wanted to pick up the challenge there.
It's a really interesting question. The president has made clear, I think on multiple occasions, although maybe not in the last few days, his view that he does not have the authority to do this. And this is in the face of some rather serious legal scholars having suggested he does. In my limited experience, presidents are very reluctant to forswear authority. I don't know if maybe you all here on the Hill have had some different experience with presidents, but in general they like to have authority. So why is the president saying he doesn't? Now, it may be simply a matter of law. He's a law professor, and he may feel that that's the end of the story. I think there's something deeper going on here, though, which is, and as an outsider, I'm entitled to express my opinion about that. I think that the president is really clear in his own mind that, and I think your question implies it. Your question about how would the market receive such paper implies this, that we dig the hole deeper here. The further we get into a governance crisis over this, the further we get into essentially a manufactured default, a whole. What did Mike say? Capital doesn't flees. Capital's a coward. Well, how about that one? Here's a bond. Here's a bond the president has issued without congressional approval, and it's winding its way through the courts, and we'll hear about it in a few weeks. Who wants to buy? That doesn't sound risk-free at all. I think in many ways, the president, Secretary Lew, many other thoughtful people have sort of reiterated this, that we can't go down this road as a nation. This is just too dangerous and too destructive. But there have been a lot of people, but let me turn the subject for a moment, because one of the reasons we can't go down this road is because our economy, there's many, many reasons. If we had 5% growth, we still couldn't go down this road. But we don't have 5% growth. We have somewhere around 2. We have tens of millions of Americans looking for work, right? Not millions, tens of millions, and these are the real problems we face as a country. Oh, and by the way, we have a radical crisis in retirement security as our population ages. These are the real crises we face as a country. Right. My fellow panelists are frankly urging measures on you that will worsen these crises under the guise of fiscal stability. The fact that we're all here, even though we have radically different views about what is important and what matters, right? Jobs versus the desire to cut Medicare and Social Security. The fact that we're all here on this panel, all smiling at each other and all saying the same thing, ought to tell you this is really serious. Right, and everyone who understands how global capital markets work at any level understands that default or flirting with default over and over again is just incredibly destructive to everyone involved in the world economy, but first and foremost to the United States of America.
Thank you, Damon. Thank you to this panel. I'll now turn it over to Representative Waters. Thank you.
Thank you so very much. Let's give a round of applause to the Secretary. Well, I'm very appreciative to this panel, and I want to thank you so very much for being here and your participation. But you know that we have members sitting on this front row, and they're just anxious to get at you. And they have so many questions. And before I call on the members, let me just say this. In particular, I'll address this to Ms. Kavanaugh. Even though we get the message about the seriousness of a default on our debt ceiling, I still get this feeling, and I got it from you a little bit earlier, that they're not going to let that happen, that they know how serious this is, and we're here, and of course we're reinforcing, but really, the reason the markets are not more volatile than they are is because everybody kind of believes that this won't happen. And so I want to ask you, is that true, Ms. Kavanaugh? Is that what you tried to tell us today?
Well, we do have a stable outlook on the rating. We do expect that that the debt ceiling will be raised by the time net new financing is needed. I think you're asking why do we think that? We think that because it's happened many, many times in the past. Many, many times in the past, the debt ceiling has been raised at the 11th hour, with various kinds of negotiations associated with that. We also think that in the current environment, the issues, and I don't mean to say the issues aren't difficult, and they're longer term, they're very difficult issues about size of government, what the United States should be spending on, and how it should be financed, and so forth. But the issues are not, in our opinion, as difficult as they were 2 years ago, because the deficit is now much lower, and the deficit is trending down. That gives a little more time, and the economy is a little stronger. In that kind of environment, usually it's easier to reach agreement. There was an agreement reached to lessen the impact of the fiscal cliff. That was all encouraging to us in thinking that an agreement will be reached. But as I said before, the predominant reason the rating is no longer AAA is because of the political brinkmanship.
Members of Congress, Ms. Kavanaugh just talked about the issues aren't as difficult. Did she put her finger on the issues as we understand them and see them now? Is something different about what's going on? And the issues that she talks about are logical ones, dealing with, the deficit and other kinds of things. Is there something else going on here that perhaps you need to tell somebody about? We'll start with Mr. Cleaver. And then I'll go right down. Okay.
It drives me crazy. This false equivalency. This has not happened before. In the past, 1995, it was a budget issue. Now it's over somebody's too tall or too short. Anything I don't like, that's what it's about. Because it has changed. I think today is the 7th time it's changed what it's about. And so this has not happened before. And that alone ought to frighten the markets. I've got my motion.
So let me ask if any of the members would like to update us on what's on the table as of the Republican conference having met. Do we have some more issues on the table? Yes, Mr. Ellison? Mr. Kildee, what are you saying?
They're on hold until to see whether or not Boehner can come up with a position that his caucus will support.
Well, as I understand it, there were a number of issues that were articulated sometime this morning, perhaps in the Republican conference, about bills or amendment or whatever it is they want to put on the floor. Did it have anything to do with the deficit? What did it have to do with? That's what I'm trying to bring out.
This is a completely contrived crisis, as opposed to in the past where at least there may have been a precipitating event or a market correction or some other external failure that may have had an effect and we may have had as an institution a difficult time reacting to it. But in this case, this is not even our inability to react to an external event. It's a contrivance. It's a fabricated crisis. And it's really difficult for me, I'm interested in others' thoughts on this, for me to find any other purpose other than this political purpose. It has nothing to do even with policy, because they can't even decide which policy it is they're trying to effect in exchange for, our acquiescence, I suppose.
Mr. Perlmutter and then Mr. Watt. Then Mr. Green, you still have your hand up? Okay, you're then. Mr. Per-
Well, let me try to sort of get my hands wrapped around it. This is different, right? I mean, the point that I was trying to make, right, and I think the point that Marie is trying to make is this conversation about the debt ceiling has happened before. Each time is actually unique. 95 was very unique because it was a double shutdown. This 2011 was different. 2013 is different. I think what you see in the market and the reason why there isn't sort of a wild correction before anything actually happens is because you learn your lessons from each time this happens, and it just gets progressively worse. Now, if it gets worse than this, the next time that this happens, correct. But I don't think the market is going to react to a pure political play. It's easy to do the math and figure out what you think is going to happen from a budgetary standpoint and what the deficit is and how you can actually bridge it. Is it revenues? Is it expenditure reductions? But when it's just pure politics, it's hard to quantify and get your hands around it. However, to Mr. Perlmutter's point, everyone is putting on protection. So I don't think that, I'm sure everyone, the markets go up and down, there are winners and losers on each side. And I'm sure someone is playing it. I don't know how you could, because there's just no way to predict exactly what's going to happen. But people are putting on protection and they're trying to protect their investments, either, for, 401k participants or for a fund or for their companies, quite frankly. So people are out in the market trying to defend themselves, which is why you see not taking treasuries, just sort of recent treasuries for repos, or you see the CDS or the cost of ensuring a possible default on a treasury going to almost 1%, whereas before it was below 2 basis points or 20 basis points. I mean, that's typically where it's been for more than 15 years. And now all of a sudden, just in the past few weeks, it's spiked up to almost 1%.
Mr. Silvers wanted to react to that discussion about something being different here. Oh, don't leave now. You're next.
I wanted to say one thing about this, which is that right now, when the debt ceiling, when we've not run out of time, when Treasury still has liquidity, there's one conversation going on, and it's the conversation Mike was describing. People, people in the capital markets are hedging their bets, so to speak, around risk-free assets, which in the past they would not have hedged, and that has costs. And the kind of incrementalism that Rob was talking about is going on, and that has costs. And depending on how this is resolved, there'll be, and whether we do it again and how soon and what that looks like, those will all have implications. We need, and they can be very bad, and they can multiply over time, right? Without ever having defaulted. But we ought not to confuse that with what would happen if we actually defaulted, which would be an event of a different order. It would be a structural earthquake in the world financial system, and we do not know what that would look like. Right? And it wouldn't be incremental. The conversation that sort of we've been having here on this panel about the notion, well, this is political really, it's not fundamentally economic, we're doing it voluntarily, we're choosing not to pay, as Mike was saying, absolutely true. But it doesn't give me comfort, because we need to understand that the reason why the United States' paper is a risk-free asset is not because of our amazing natural resources, although we have them, and it's not even because of the productivity of our workforce or the level of our capital investment. That's not why we are risk-free. Argentina has amazing natural resources. They went bankrupt, right, and they defaulted. The reason why we are risk-free is because of the confidence of the world in our political system, and that our political system will function properly, and that we will make rational decisions. And that confidence has been built up over a long period of time when we did indeed do that. Right? We are on a path of dissipating that asset, and that is our most important national asset.
Well, you know what's very interesting, and I'm going to get the members going right down the road here. Mr. Green is going to be next. What's very interesting about what's going on here is watching and knowing and understanding my colleagues who are elected officials and politicians, and looking at economists who deal with, we have sometimes different views of the world and what is causing certain things to happen. Now, we had an article that appeared recently where some very significant individuals in the business community said they were going to rethink how they give support, for example, because they are dealing with an element that they have not had to deal with before, and it's unsettling that there is an element now that's influencing this debt ceiling discussion, and it has nothing to do with the kind of logic that the economists are laying out here to us today. Mr. Green. I could speak.
I think I'll start if I could. I think the key in the phrase of full faith and credit is faith and belief. And so the answer to your question, Congressman, is there a point where the rest of the world, the American people, could lose faith in the ability of the U.S. government to honor its debts? The answer is yes. If we default and don't fix it, it's highly unlikely, but if we let that default ride, the markets will respond harshly. Capital is a coward, and they will punish the U.S. and lose faith in the U.S. for failing to act to protect its own ability to pay its debts.
I mean, I would say this. I mean, I don't know. I think I've just been here too long and just way too jaded. But I mean, we've seen this movie a lot on a number of different topics, right? When it comes back to TARP, regardless of your views on it, and everyone has one. During that time, the market didn't have confidence that the Congress would do something, and that all the banks were going to go under, and then therefore all of the knock-on effects on the economy. And then Congress actually disappointed and didn't approve the payment. And what happened in the bond markets, and everyone saw that the Dow Jones went down 700 points, that was fantastic. What they didn't see was in the credit space, there was no liquidity. And that was a real problem there. And as soon as Congress came back and passed TARP, then the market reacted. The market wants to get to an equilibrium, right? So it's never a thing where the market is going to punish you just because, you know, they're expressing a view, right? The market wants to be able to get back to equilibrium, so they're going to react, and then they're going to react to what else comes out. So I don't think that it's fair to look for, and I hear this all the time on the television, I don't think it's fair to look for the market to give anybody a signal as to, you know, you're going too far, you're doing the wrong thing here. The market's going to ebb and flow. And if, God forbid, that, you know, the default occurred and then nothing was done by the 17th, but it was done by the 19th, there's going to be an impact, but then the market's going to swing back. And if it were to the extent where it went for longer than that into November, which some people are talking about, yes, it would be a worse impact, and then the market would come back. Now, the only time that the market wouldn't come back is if you never did it, which, again, that's not something that's sort of baked into the cake, if you will. So, again, I don't mean to imply that the market doesn't care. It does, but it's very elastic. And I think that, you know, the last time I heard a lot of criticism, well, the market really didn't do anything, you know, after 2011. There was no reaction, which spurred on the sort of the bad behavior. That's not necessarily the case, but I don't think, again, it's fair to look for the market to punish behavior as opposed to just react for the benefit of the market participants.
Let me get Mr. Ellison in here, and then we're going to come back to you. Just 1 second.
Yeah, my question is going to take us off this subject a little bit. So
Oh,
if
well,
you want to jump
let's
in,
stay on, yeah.
I mean, okay. Well, let me ask my question, and we'll deal with the other. Well, however, so on the 17th, we lose authority to borrow. That's what happens, as I understand, on the 17th, and then we're basically paying bills based on the actual cash we have coming in, and so I'm still a little fuzzy on the actual date that we're thinking of a bill not being paid or some bond that matures actually not being paid. Because, as you know, that's one of the things. You know, I asked one of my Republican colleagues, you guys, could you possibly be saying you're not gonna, you don't think the debt ceiling's real, or if we break it, it's not real? And they say, no, we don't believe that. We just believe that it's not going to be on the 17th exactly, or on the 18th, and there's maybe flexible. I said, well, but you don't know when that is. So anyway, can you answer that question, or can you answer with any kind of, give an educated guess on when we reach that point?
Well,
yeah, anybody.
My understanding from the Treasury Department is it's like this. On the 17th, as you said, the borrowing capacity of the United States runs out. We will have approximately $30 billion in cash available to meet our obligations at that point, and money will come in and money will go out, right? And there is volatility in both, and the volatility historically has been greater than $30 billion on a daily basis, right? So that we might have a couple of good days, in which case puts it off a while. We might have a bad day, and if we had that bad day on the 17th, it would be a really bad day. Right, that's the nature of the problem, and the administration has identified the 17th because they do not have confidence that, absent raising of the debt ceiling, that in all likely circumstances they'd be able to pay the bills. Right. And so your colleagues who say to you it may not be the 17th are right, but it may be the 17th. You just don't know, and I think that raises again, there needs to be some clarity about what goes on here, right? One thing that will go on here is a debt ceiling will be breached, at which point our ability as a government to manage uncertainty will be radically diminished. The second thing another thing that may happen, and in relatively short order, is that as Rob was talking about, some obligations of the United States to the government's employees, to our contractors, to Social Security and Medicare recipients, some obligations will go unpaid, and that is a breach. Right? That is what a creditor would consider a breach. That's next thing. And then, in terms of the kind of world financial system issues, you come to this issue of not making a payment on our debt and on our Treasury bonds and notes. Right now, as a legal matter, it's not entirely clear to me there's any difference between 1 and 2. I mean, between 2 and 3, like not having the flexibility is not having the flexibility. It'll make everybody very nervous, but it's not a default. 2 and 3, not clear to me there's really a difference, but some people would argue there is. We will, Secretary Liu's been very clear. You can't rest on the assumption that we're going to hit 2 and not 3.
Yeah.
Right. Now, I would just add to this, and this is sort of in response to the prior conversation, because despite what you said, I think they're really kind of knit together, that the notion we do these things and then we repair it, because we will repair it, right? We've got the money as a country. The idea that we can't pay this is silly. We of course we will repair it, but we won't ever be able to repair not meeting these obligations. Keynes said famously, in the long run, we're all dead. What he meant by that was that markets readjust, yeah, but we all live in the time of the readjustment. It can be mighty, mighty painful, and once we breach, we don't know what the knock-on effects are. And let me be concrete about one of them that worries me a great deal. One of the most profound problems in 2008, which didn't get a lot of attention, and it was related but not the same thing as the freezing up of credit markets that Mike described, it was an enormous problem. But one of the things that happened was that our money market mutual funds, a couple of them broke the buck. People put money in money market mutual funds believing that they are essentially as sound as an FDIC insured account. They're not. We broke the buck. The safest money market mutual funds in the minds of most investors are federal money market mutual funds that invest in short-term Treasury paper. If we don't make a payment on a piece of on a short-term Treasury obligation, all of those funds are going to be in the position of potentially breaking the buck. Now, I don't know how they'll manage it and how big that position will be, and nobody knows, right? What's our capacity to stop a run? Right? I mean, there are people right now in the Treasury Department and other places and the Fed thinking about how to manage this. But what's our capacity to stop a run? And if there is a run, understand that many of our financial institutions depend upon those funds to supply them with financing. Right? And how resilient are those institutions? Remember, they're all dollar denominated. Right? This would hit at the same time as there would be a larger question about the value of the dollar, right? That those institutions would be trying to manage. It's not that this is all guaranteed to lead to catastrophe, but these are the dynamics that produced catastrophe in 2008, and we don't know. And it's astounding that anyone would consider voluntarily stepping into this risk. Right?
So
going back to what Mike said.
So Damon, let me just say real quickly. So let me just say this. So you guys know this stuff better than we do, or at least better than I do. But I buy everything you're saying. Those guys on the other side of the aisles, as smart as we are. No. Why aren't they? They are. I mean, we're not talking about IQ. We're talking about something else. Why aren't they reacting? Why aren't they reacting? I guess you can't tell me that, but I just thought I'd comment on, raise that question.
Just two very quick points to the conversation we've just had. First, on money market funds, we talk about the repo market. Money market funds are a key source of financing funds in the repo market. To the extent they pull back at all, that has a consequence. It has a cost to financing these institutions. And earlier we were talking about full faith and credit and how markets react and making you pay for it. Yes, markets seek an equilibrium and but they incorporate the new information. The new information, if we actually do breach the full faith and credit, over time, it's going to cost. That's a new fact that will be incorporated into the provision of credit, and that's going to have a cost long term.
Thank you. First of all, I do find it a little bit interesting, ranking member, that in the run up to this potential default, and I congratulate you for holding this, that there hasn't been an equally serious discussion by any other body within this Congress on the potential implications of what some on the other side seem to be willing to embrace. I find that really troubling. But so thank you for doing this.
Oh, sorry.
The thing that I want to just follow up on and get maybe a little more specific, and Marie, this may relate to you, but others as well. What does the new norm look like? Say, even if this is a short-term breach, and it is a new day at that point in time, having served in local government for a long time and managed the credit of my municipality, I understand that there are certain things on the ledger you can't erase for a long, long time. How long does it take if we do this, if this happens and it's a politically driven event, particularly in the context of the fact that it's a politically driven event, how long does it take for that to no longer be reflected somehow in the market? Or is it something that's an indelible mark that we may long deal with?
I'll leave it to some of the other panelists to talk about the market, but in terms of the rating, if contrary to our expectations, the government does fail to service debt on time in accordance with its original terms, Standard & Poor's would change the rating to SD, which stands for selective default, which is the term we normally use for sovereigns that failed to meet obligations, because sovereigns, it's not like you don't file Chapter 11, there's no legal framework, so they often pick and choose in terms of, oftentimes the default doesn't incorporate all debt, so that's why we use the term selective default. Once that default was cured, we would assign a rating in accordance with our criteria, looking at a range of political and economic factors. We haven't said anything about, well, first of all, we don't expect the default to happen, and so we certainly haven't said anything about that rating. And it's very difficult to ascertain, because as other people have pointed out, this would be an unprecedented event, and it's not clear what the full impact, we've already seen some impact on the financial markets, it's not clear what the full impact would be in the financial markets or the real economy, both in the U.S. and globally, because the dollar is used around the world. So it's difficult to say. Certainly, as others have pointed out, the fact that the U.S. is the world's premier reserve currency is the product of long-standing developments over decades or a century or more in terms of political stability, respect for rule of law, respect for property rights, center of innovation, a lot of different factors. It takes a long time to build that, and it's unclear what would happen if there were an event that really nobody has expected.
Ms. Richardson wanted to respond to that, and then Mr. Foster, I see you have the microphone there, so would you, after Ms. Richardson?
I just wanted to make the point, and I agree with Representative Green, that this is not 1995. The economy is not as resilient as the stock market. The markets may ebb and flow, but the consumer sector will not. We still have an unemployment rate of 7.3%. We have a labor market participation rate that's the lowest it's been in decades. We do not know the entire effects of this debt ceiling debate and the government shutdown, because the government's not releasing any data during the shutdown. So we don't know what the unemployment rate is now and what the other indicators look like. We also have a GDP that's far lower than it was during the roaring 90s. And so we have an economy and a business sector that is sitting on piles of cash that it will not invest because of, in large part, political uncertainty. And so this effect, these issues are not just about markets, though I agree they are very important. It's about households. And our household sector is suffering because of this political dysfunction right now.
Mr. Foster?
Yeah, I was wondering if I could get you to venture a quick guess as to how this would compare, for example, to the failure of the first TARP vote. And would you regard that an actual default would be a larger event to our economy than the failure? I see. Is there anyone who does not believe that that would,
I think it's fair to say that I'm trying to think of the multiple in my head of what that would be like.
Bigger than one. Okay.
Yeah.
Now, what would the multiple that you might venture be compared to the 2011 crisis? The first time the Republicans wandered near this cliff, the market dropped by 17%, household net worth dropped by $2.4 trillion, which basically took $20,000 out of the pocket of the average American family. All right, and that's actually one of the big political changes here. I think that the average American understands that when these sort of games are played, that real families suffer, and that's one of the reasons. But I was wondering if you think that if we go through and have an actual default as opposed to a threatened default that we had in 2011, what is your multiple that you might venture there?
I don't think anyone can quantify that. I mean,
more than one.
Yeah, I mean, that's like asking, how much more pain can you take than 10 on a scale of 1 to 10, right? I mean, once you get to 10, it doesn't even matter anymore. I think, the parallel that I would draw is the private label mortgage securities market, right? And that hasn't come back since the crises, and probably won't come back without, some more restructuring in that space. And what that has led to is a over-reliance on the government providing a backstop for mortgages, either directly or, through the various programs. And all of those things have knock-on effects, because you see that then it becomes too heavy for one agency to carry. And then, so is it another agency? Is it another agency? Then it trickles down to the consumer, because as a consumer, whereas before, if you were someone on the margin, you may be able to get credit. Now you can't at all. And so it starts to constrain the flow of credit, and it impacts real life
So there's
people.
no objection to the fact that it would be way worse than 2011.
Yeah,
And
but
so
I would say that if
the
you-
average family can anticipate a lot more than $20,000 per family of
Also,
dropping net
Congressman, I
worth.
mean, it would be an event of a different kind. I mean, 2011 was fundamentally an issue of the markets, and to some extent the consuming public had a decline in confidence, which affected prices in the relatively more volatile equities markets, and to some degree in housing. What we're talking about when we talk about default is an event that threatens a liquidity crisis, which the only example of which that in the United States that any of us have lived through was 2008. And so, and if you think about the long-lasting nature of the liquidity crisis's effect on our economy compared to that confidence event, right? It's as Mike was trying to explain, it's something of it's a different kind. It's orders of magnitude. It's potentially orders of magnitude worse. And when you talk about knock-on effects, I was asked, and we didn't get to this at all, so I'll throw this in. We talk about jobs, employment, and growth, right? There will be, if we default in one go sometime in the next few weeks, there will certainly be cascading effects, some of which will be very long-lasting on jobs and growth. And much as we saw in 2008, right? The initial events in 2008 were a financial crisis. As Neela just said, we are still living with the consequences in the labor markets and in terms of economic growth from that crisis 5 years later. But I would add to that doing this in dribs and drabs, right, threatens something similar, but over a longer period of time. And in either way, as Rob said, it's very hard to reverse, and will take a long time to fix once we go over that line.
If I could just close by just returning for a second to the first TARP vote, which I think has a lot of political parallels to what we're going through. I was just looking at the roll call for the first TARP vote, and it made my heart break when I saw the long list of moderate, reasonable Democrats, people like Melissa Bean, and then liberals like Keith and Maxine, who took this very, very tough vote. And then people like Melissa Bean and like Bill Foster, who saw a large amount of Wall Street money go after them in subsequent elections, and in the case of both Melissa and me, to actually lose. And I was wondering how many times we have to go through this before Wall Street gets the idea that when a crisis hits, one party is predominantly the adults in the room, and one party is the ideological party that actually drives us up to this ledge. Maybe that was just, I'll leave that to be a statement.
Well, Ms. Beatty? Not before I finish with the members.
Thank me.
Hold on one second.
Thank you, and I'll be brief. First, let me just thank you, Congresswoman Waters, for bringing us together. I know one thing I'll be saying a lot, and I'm going to borrow that from your words, Mr. Williams, and that is market with a capital M is a coward. I guess in light of, I won't repeat it, of all of the facts and statistics, Ms. Richardson, that you just mentioned, one of the things we're finding out to Congresswoman Waters' initial question when I came in, I think it's different that we have a president that's different. I think that it's political. I think that they took his signature program that had been the signature from Democrat and Republican presidents and attacked it, and that didn't work. So here we are. My question is, last week, some would have encouraged that a 6-week short-term fix would be a positive and something better than not having anything. Now we're hearing that it's a 6 months fix maybe, or a January 15th fix. So when you look at the market and you look at the economy and you look at where we are with unemployment and jobs and all of the rest, what signal do we send if we say 6 weeks, which is really nothing? It's buying time, in my opinion. What happens when people are encouraged to say, let's just take this vote because it'll send a signal to the political public that we're trying to be civil and we're working together? But what does that do to the capital market with a 6 week?
I mean, from my perspective, this is baked into the market, right? This kind of dysfunction now, it's anticipated. I mean, after 2011, you can't surprise anybody anymore. And, you know, I could say legitimately 2011 was a surprise, even after the TARP vote. And even after everything that went through on the financial crises, people legitimately thought, given all of the given the situation in Europe and given all of the volatility in the rest of the world, there is no way that the Congress is actually going to get to this point. And then it happened. And then, so when the 2012 vote was not a surprise to anybody, and now so it's just this whole halting, getting from one stop to the next is baked in. Now, a default changes that dynamic completely and resets the bar much lower. But if you do a 6 week program, the market's going to feel, okay, here we go again. If you do 4 months, 6 months, whatever, what the market would prefer is a longer term solution, right? Is to get the sort of, and I know this is becoming a bad word, but get the grand bargain, get it out of the way, and have a 10-year window so you can see. Now, no one expects that 10 years is going to be 10 years because a lot can happen within 1 year. But if you have an outline of a plan, then at least from a market perspective, and I'll speak from an investor perspective, you can then say, okay, at least I know what it is they said they're going to do for the next 5 years or 10 years, so I'm going to plan to put my capital to work accordingly. Now, as an investor, you just sit on the sideline and you just wait and you see how things work out. And if there's something that tickle your fancy, like going to Treasury and putting your money into a Treasury, I don't know if you want to do that today, then you just keep your money on the sideline or you put your money overseas. But you don't put your money into anything that would require any kind of long-term commitments.
Congressman Mel Watt is back. Thank you.
Thanks. I'm sorry I had to run out. I had a 3:15 call on my schedule that I needed to take. So actually, you wound your way right back to where we were before I left the room, and I'd actually raised my hand at that point because I wanted to address the question to Ms. Kavanaugh. As I understand it, the market, our debt rating was downgraded because of political uncertainty, not because of any inability that anybody perceived to actually pay our debts. So I guess the question I wanted to raise is how dysfunctional do we have to be politically to get downgraded again? Because it sounds like you've got us listed stable. You're not planning to downgrade us any further. It may have some, the uncertainty may have some consequences on short-term rates, but at least the official rating is not downgraded so that our interest rates jump up precipitously. What do we have to, how dysfunctional do we have to become politically for you all to take that into account if you've already taken it into account in downgrading us the first time?
Right. Well, we have a stable outlook, which means, in our opinion, there's less than a 1 in 3 chance that there'll be a downgrade within the next 2 years. We had a negative outlook. We changed it to stable earlier this year. Now, we produce all of Standard & Poor's produces all of its ratings in accordance with published criteria, and our sovereign criteria focuses on a wide range of political and economic factors. The political brinkmanship, the separation of the spending and funding decisions, and some of the high level of debt now, and the sort of the longer term fiscal issues that the country needs to address. Those are all the constraints on the rating. But there are those are all the constraints on the rating. There are tremendous supporting factors as well. The diversified economy, extensive monetary flexibility, the reserve currency, which I'm going into because we've talked about a lot, but also the ability of the authorities to use economic policy countercyclically and proactively as they did throughout 2008 really into 2010, when fiscal and monetary measures went very far, in our opinion, in preventing a larger downturn in the United States and perhaps in the world. And so there are a lot of strengths. So we're looking at the strengths and the negatives and weighing them. And in our opinion, those are balanced at the AA plus level. That doesn't mean that as new information becomes available that those things can change. But there's no, I mean. Well, it's AA plus. We have a 20-point rating scale, and the AA plus is a high rating, but it's not the highest rating, which the United States had for many years, many decades actually.
Okay, Mr. Perlmutter, were you finished? All right, thank you. Thank you very much. I think that takes care of the members for right now, and we have someone here from the majority who would like to raise a question. Would you identify yourself and move forward with your question? You're not.
J.W. Verrett, I'm the chief economist for the committee, and I've been studying this issue for about a month now, and I want to ask about a couple of indicia that seem very strong to me that question the assumption that failure to raise the debt ceiling amounts to default on Treasury obligations. Mr. Williams mentioned one of the clearest indicators of the market's perception of this being the CDS market. And while it is true that rates have gone up significantly, it's also true that the volume of coverage on the CDS market is still infinitesimally small in comparison to Treasury obligations that are outstanding. There's more protection for Volkswagen default than there is for the U.S., despite the fact the U.S. issues about 2,000 times the debt. So that, to me, questions the market perception. And then there's also representations by a number of members of some of the trade associations represented today in advice to their own investors that question the assumption that Treasury is unable to prioritize payments for debt, for Treasury obligations operationally. And then, in fact, it is operationally feasible. In fact, it's likely. And in fact, speaking particularly to Goldman, they suggest that it's operationally impossible to stop payments on Treasury obligations because of the way the system is set up. But even to the extent there is any uncertainty about whether failure to raise the debt ceiling amounts to default on Treasury obligations, couldn't the Treasury make this, at least alleviate some of this uncertainty, some of this concern by capital markets, by showing to us their plan for prioritization in the event the debt ceiling isn't raised? Because we understand that internally, they're making that sort of contingency planning. We know internally the Fed, they are as well. So couldn't they clear up a lot of this uncertainty by just sharing that plan with us?
Speak up so that we can hear you.
Yeah, when you say structurally they can make their payments, they have to make all of them, is my point. They can't pick and choose, well, we're going to pay the interest payments, but we're not going to make these other payments. The way that their structure is set up is they pay all of them. So they need $72 billion to be able to make sure that they maintain the outflows of all the payments, Social Security, everything else that they have to do. If they don't have that, then they're not going to pay, right? So if you have $30 billion and you need 72, you're not going to pay $30 billion worth of obligations because it's not going to be coming down the list of, well, I'll pay you first since you just happen to be number one on the list, and then everybody past number 15, you can't get paid until we get more money in the door. So that's structurally how it is that they're set up to make that payment. Now leave it to others to
Well, before the others chime in on this, what he is suggesting is that they should set up a plan where they show us how they prioritize, no matter what you say is the way payments are structured, that they should have a plan for prioritizing how they pay. So you have a basic disagreement here.
Well,
you're saying it can't be done. You're saying that it should be a plan.
Well, no. I think we're saying the same thing. I think the point that he's making is that Treasury is working on a contingency plan, which any sort of reasonable person would do. From a market perspective, I mean, again, I'll speak for myself. I just take my SF hat off completely. But from a market perspective, if Treasury came out and said, this is a plan that we're going to have, this is sort of our break glass in case of emergency plan, I would be scared.
Me too.
Because,
You know.
I mean, essentially what you're telling me with that is,
Ask for more details about what happens in the event the ceiling isn't raised. I mean, that's one last week, and I'm not.
Excuse me 1 second. Mr. Perlmutter just got to say something here. Yes.
I have to respond for a second. 'Cause
Yes.
This really burns me up, this question. You know, I'm a bankruptcy lawyer, that's what I do. Okay, when you start prioritizing debts, it means you're gonna default. Somebody's gonna get screwed. All right, that's the way that works. And Article 8.1, the Congress shall have the power to pay the debts. The debts. 8.2, to borrow money on the credit of the United States. Those are our first two obligations, to pay the debts. And then the 14th Amendment that somebody was talking about says it doesn't distinguish between Wall Street and China and the guy who's mowing the lawn on the mall. It says the validity of the public debt. That's all the bills. And so I found when your guys offered this prioritizing the debts back in March to be repugnant as all hell, and I still find it. We took 235 years to be able to draw money on an unsecured basis because we paid our bills. You know, it isn't just decades or a century, it's 2 centuries at least. Started with the Revolutionary War. That's why we have good credit. And that's why that's the first thing that Congress has a responsibility to do. And so, to your committee, and with all due respect, you guys pull that stunt. I think it is so unpatriotic, I can't tell you. And it just really burns me up.
We have a basic disagreement here.
Well,
Okay?
it's a legal, it isn't just economic,
Yeah.
it's a legal and constitutional level of the disagreement.
Okay.
I-
All
I
right.
had
Thank
to say
you.
that.
Well, you did. Thank you very much. Are there any other comments on prioritization or any
Yeah,
other? Yes.
One. Just one piece on that. I mean, we've done for the last year plus, worked with our members to look at contingency planning, particularly in the operations area around how Treasury securities are processed and settled. One thing we've noted, for two reasons, we just would like to hear from Treasury if they're not going to make a payment on a given day in the Treasury space. We'd like to hear early, which is defined to mean early in the evening before markets open in Asia, because we think it would have that's a significant data point for those markets. So that's 8 o'clock Eastern time, and as well to let the settlement process move normally, so firms can, run their own settlement processes in a smooth, operationally less risky way. And so that's one of the key items we've looked for, is just tell us early the day before.
Yes, Ms. Beatty?
Let me just quote something that was very helpful to me that comes from SIFMA on prioritizing payments. It is not expected that the Treasury could, in order to avoid default on outstanding securities, prioritize payments because of both the legal and operational constraints. Treasury processes nearly 100 million payments monthly and has asserted that it would be impossible to make the necessary changes to implement a priority payment system. Sounds okay to me. So my response, quoting experts to us in lay responses as a staff or a congressional member, would be my response.
What kind of shocked me from 17 markets when we started this process of priority. But the answer to the gentleman's question, though, is this is theoretically possible. Practically, it's insane.
Well, on the issue of the CDS, I didn't want to leave that one out there. I think the point there is, yes, the CDS on the Treasury market has always been infinitesimal because it's Treasury, right? And then there's no one has any thoughts that somehow you need to buy protection on Treasury, which is why the number's been sort of, if you look at the chart, it's flatline forever. And well, again, it's sort of apples and oranges, right? It's apples and oranges. But again, the point is not so much how much protection is out there on Treasuries, because I mean, if you got $17 trillion worth of outstanding obligations, that's a lot of obligation to have a CDS market. And if a CDS market existed that was huge in that space, then I think that would sort of speak to the ratings ratings issue. But the point is not the size of the CDS market, it's the growth in the price of protection in that space, right? Because if you look back during the crises, the coverage that people were buying on all of the big name banks, the market in that space wasn't huge because no one was issuing any debt. It was just a cost associated with it. And then you saw it with Greece, you saw it with Spain and Italy, you saw it with all the countries. It's not that the volume was huge and the volume was increasing, it was just a spike in the cost of coverage. So that was the point that I was trying to make.
Yes, please, Mr. Cheston, and then we're going to come back to Mr.
I just want to
Silvers.
make a couple simple points here. If we're wrong, bad things happen, and they happen very quickly. So we don't want to get to the point where we're even questioning whether or not we're wrong or whether or not we have the date wrong. Second is there's a tremendous amount of economic potential sitting on the sidelines now. You have small businesses that want to expand. They want to hire workers. You have larger corporations sitting on a tremendous amount of cash. You have banks that have a lot of money willing to lend if they had the demand to support it. And it's uncertainty that is killing this. And if we extend that uncertainty and we don't pay our debts, and second, we need to deal with the debt levels because every credit card user knows it's both paying your debt and managing the debt going forward. If we don't do that, we will not unleash this economic potential. There's a tremendous amount of potential. We need to clear this uncertainty.
Thank you. Mr. Silvers?
Yeah, partly I just want to reinforce maybe in more sort of market terms what Mike was saying about this issue of the CDS spreads. I mean, I may have this wrong, but those are big institutional markets, and nobody and that number, even though that market is small, the size of that market tells you other people aren't coming forward to take on the risk. And if you think about that, we're talking about short-term treasuries. The fact that price has moved up and people aren't entering and money's not flowing in, right, seems to me a very disturbing point. I would, though, Mr. Verrett, want to say that one of the things you said is absolutely true, which is that not raising the debt limit by itself is not a default. Right? The world's not going to end the moment the world's not necessarily going to end the moment we don't raise the debt limit. But what it means is that we'll be in a place where, in the judgment of the people at the Treasury who do this day in and day out, we can't be sure we'll have enough cash. We're entering into that space. And then that goes to the point that somebody said earlier about when do things get out of control, right? We start putting ourselves in a place, in a risky spot, and I think this was Jim's point, where something really unbearably bad could happen, and we might not be able to control it. And finally, I think I'm in a position on this panel to be able to observe something kind of strategic about this situation in response to the question of why doesn't the Treasury put the plan forward. I'm sure they have their reasons. Let me tell you mine if I was them. You're telling me you're about to shoot me in the head. And you're asking me, what's my plan for getting to the hospital so I don't die so you're not charged with murder? Why would I tell you? It just increases the chance you're going to shoot me in the head. Think about it.
Well, what a note to end on. Let me take this moment to thank all of our panelists for coming here today to share with us your expertise, your knowledge about finance and about debt ceilings and about shutdown and all the things that you have talked about. We're very appreciative. While we have a lot of members who are talking about whether we should or should not raise the debt ceiling, we've not had a lot of expertise in those discussions. And so I'm very pleased that you have come today. And we will continue to seek your advice and information as this thing plays out. I would like to have as much hope as some of you have indicated here today that it is the debt ceiling is going to be raised, that we're not going to default. The president has said that. Mr. Boehner has said that. But then something happened today that makes us believe that perhaps it may. And so with that, again, let me thank you. Let me also thank the letter that I received from you, Mr. Talbot, from the Financial Services Roundtable, indicating that the Roundtable, all of the financial institutions, are adopting prudent financial arrangements with their customers who may be experiencing financial difficulties as a result of the temporary shutdown of federal government. And you go into it in quite some detail, and I'm very, very appreciative of that. I know that our members are going to be thinking about a lot that we've heard today. You have impressed upon me a couple of things. One is, why do we have this debt ceiling debate at all? Why? We know that we have to pay our bills, and so even though we've heard the history of how it came about, perhaps it's time to think about eliminating this discussion in the future by not having the limit that is set, because we know we have to go past it if we have to pay our bills. The other thing is this short-term expansions. I can see how it creates uncertainty, and it does not make good sense. And so we're not happy, even though there's supposedly an agreement that we're approaching, something's on the table. The length of time that's involved does nothing to erase the uncertainty that you have so well defined here today. So I think we'll take this information back as we discuss this crisis with our caucus, and you have helped us an awful lot today to be able to be a little bit more expert in discussing this based on the information you have shared. Thank you very much. A big round of applause for all of you. Thank you.